So here we are, the introduction of technical analysis. Technical analysis is a study of price movement patterns of the security. Super easy. So we look at historical data, we look at indicators and things that tell us where things are moving, how they're moving, why they're moving ish. Not really why, but all based off of price, volume, and a lot of other things. So it's important for traders to be able to understand what to do with the market in order to predict it, right? So you have to know what has already happened to have kind of something to base it off of. Now, it's not going to be always 100% where, oh, it's going to follow the same exact historical pattern. Well, it's not, because, we have more participants now and more things are going, just a lot of different things now compared to, if you're looking back years and years ago. If you read a lot of books on how to trade with technical analysis, they go over stuff from like 1920. It's wild. Um, it's crazy to me. I do have a good book. If you want it, just let me know. And if you want this PowerPoint, do let me know that too, because I will get that. So we're going to use indicators to help traders decide to come to a resolution to take a trade or not. I'll wait for Duca to finish. Yeah, absolutely, Duca. I will throw that in here in just a second, because the screen is on my actual browser. So specifically for me, I chose, I did technical analysis because it's the only thing that actually made sense to me. I come from a huge background of mathematics, lots of physics and things like that. So the only thing that makes sense to me are numbers. It's the only thing that makes sense is how things move and why they do things based off of, and I specifically work with oscillations and things like that. And that's my personal preference, right? There's a lot of ways to go about it, but the first thing we have to talk about, which you can trade purely off of price action and levels, right? So price action, what is that? That's the study and analysis of how the price moves in the financial market, how it behaves over time. And you can use indicators to help, determine and figure out underlying decisions and things that are happening in the market based off of the prices alone. Now, price action does offer flexibility. It offers a lot of ways to approach trades depending on your strategy and your system. And it allows you to understand a very dynamic kind of fluid motion that happens with the market. And we get all this data and things go haywire for like a week, and we're like, but why? Like everybody's as Moist said recently, everybody's long in depression data, and it's funny because it's what it looks like. How else would I just learning how to? That's a really good question too, Duca, because you don't need to really understand mathematics on trading is a math game. But that's why we have indicators to do the formulas for us and show us visually how that's moving, right? So I use a stochastic RSI all the time because I like to know if it's overbought or oversold. If it's overbought and it's all the way at the top at that 97, it's probably going to come down, but that's based off of a mathematical formula. We're not going to be going over all the mathematical formulas and that sort of thing, but to understand, it calculates it for you, so you don't have to really do it. So we're going to try and take a flexible and intuitive approach, right? So we focus on the price chart, right? We all know what charts look like. They got the candles, it's red and green, tells you how the price moved that day, or depending on what time frame you're looking on it. If you're looking at the day, then you're looking each day which way it moved. So this will help you analyze the chart, analyze the price movement, focus on patterns, trends, support and resistance levels, key price levels. Another thing you can keep in mind are psych levels. You know, we all know those kind of, 5,250 is going to be a big one. It's wild, but that's how the human brain kind of works, though. So we think about patterns and formations. We have common patterns that happen all the time. Some people do trade off of, if we're in a trend, we trade off of the channels. Sometimes we get into consolidation, we end up in triangles. Sometimes we ride back up, hit a double top or a double bottom. And sometimes that double top and double bottom turns into a triple top, triple bottom, and then, so you're stuck kind of analyzing a little bit deeper what is happening in the market, right? So we look at price formation, trend analysis. We try to look and see if there is a trend moving. We look for higher highs, higher lows for an uptrend, lower highs, lower lows for a downtrend. And understanding trends is going to help you, determine the direction of the trade and kind of potential entry and exit points too. So supports and resistances, we all kind of know what these are. Supports and resistances are levels of key price levels where buying and selling pressure is concentrated. Um, the price action traders pay close attention to these levels as they act as barriers, because that's what they are. They are barriers in our way to get past. They're not for me to get past, or because I don't have the money to get past them. For big institutes to do. My job is to figure out if they're going to try and break past it or not. Now, how do I figure that out? Well, you don't. You do, you don't. But you do things with risk management and things like that in order to try and keep yourself protected from things going the other way. And that'll be another educational thing that we'll do a little bit down the way. I'm still working on that PowerPoint. I got to send it to Riz and have him look it over for me. So we do candlestick analysis. We do look at the context and confluence, so the price action of the broader market. So we do look from a bird's eye view, and then we go in and we zoom in and we try and find the entry or the exit, right? And this may combine price analysis and other forms of trend analysis and volume analysis. You can do Fibonacci retracements, and those are all ways to increase your probability of success, right? There's also the psychology of the price movement, which I kind of touched on with institutions, but price action analysis just takes into account the psychology of the market participant. You're just trying to figure out why is that? It's a good question to ask sometimes. A little Socratic, but it's a good question to ask. I started trading like 7 years ago. I started seriously trading and becoming profitable probably about two or three. Like seriously profitable. Does anybody have any questions? I was also not trading full time at that time when I was trying to become very profitable. So it depends on how much time you have to dedicate yourself to the craft. It's just like any other skill that you learn. The more time you spend learning your craft, the better you will be. It's like take anybody who paints. If you compare somebody who painted a self-portrait of themselves when they were 18 compared to when they were like 60 something, there's going to be a huge difference, just because of the time and experience that you get from being involved in being and participating in the market. I mean, technically my first year that I traded common stocks when I started swing trading, I was profitable, but I don't exactly count it because it was all. I don't really count it because I ended up liquidating that whole account and all kinds of dumb shit back then. So the reason I have a 15-minute, 3-minute, 4-hour question mark on top is because we don't know what this chart is. So it's kind of to get you thinking that, depending on how you're viewing a chart on what time scale and what time frame, um, depends on how you're interpreting the data, is essentially why I have this set up this way. So candlestick charts are commonly used in technical analysis. They represent the price movement of stocks, currencies, commodities over time. Each candlestick tells you what happens during that specific time frame that you're looking at. If you're trading on a 2-minute, that candle is a 2-minute life. You know, you keep in account how long that life is. You try to figure, once you understand that there's half lives of candles and things like that, and you understand that they try to push up and they push down certain ways. And you start becoming more informed about your decisions by looking at candlesticks more frequently and watching them form. Um, these patterns that these candlesticks make provide insight and sentiment for potential future price movements. So, depending on the type of triangle you have, it might go up, might go down, depending on if it came down first or if it went up first. I don't trade off of patterns specifically. I know a couple people who are pretty damn good at it. But those have their probability, and those people trade off of that for certain ways and certain reasons. So we're going to start learning how to analyze candlestick patterns with other technical indicators, right? Because we have to have something else for confidence, right? Because we can't just be like, yeah, it's going to go to the moon. I mean, you can have that, but I don't think that's going to be the the best way to kind of go about it. Candlestick wicks. What? I like getting on pivot points. So I try to get in on wicks specifically. But wicks can tell you a lot of different things, and we will get into that once we start touching on the actual candlestick itself. So again, just looking at candlestick charts from the bird's eye view, zooming in and just trying to understand and gain perspective on which ways the market's going to go so that you can make a decision. So understanding the big picture, I've said it like 12 times now. Gotta understand the big picture so that you can get rid of a lot of noise. And there's a lot of ways to get rid of a lot of noise, right? I was trading off of range bars for the longest time. I now use Heiken Ashi now, specifically because I don't like that extra. And that's a personal decision. It might not work for everybody. It just works for me. So it does take a little bit of trial and error to kind of find the right things to give you the right confidence, right? So zooming out on these charts and these bird's eye views are going to help you find those key levels of resistance and supports and kind of give you that reference for setting price targets and kind of your stop loss levels too. There's much deeper ways to go about stop loss and risk management and things. We will be going over risk management in another educational format. So just keep your eyes peeled for that one. Me and Moist are working on it a little bit, so we want it to be really good for everybody by the time we present it. So we're going to recognize levels patterns on different time frames and try and anticipate potential price reactions and adjust your strategy accordingly. So something that happens a lot is you're going to have to adapt and adjust because things change so very fast. Even if you're just trying to one con contract on ES is, you're just trying to adjust. And if ES is doing some weird stuff like it did, Friday was a little weird, I guess. It went straight down and then it recovered, right? Wild. That's crazy to me, but that's the market, and I say it all the time sometimes whenever I'm hanging in the trading floor. The market always surprises me. It does, it still does. And I think that's kind of the beauty that the market gives with this kind of craft, because it's always changing and it's always evolving. So it's always kind of keeping you on your toes, and that's exciting to me, personally. So you take time to assess market structure, examining the structure from the bird's eye view. Again, you know, you can assess the strength and stability of the trend, um, the volatility of the price movement. You can look and see if there's any significant price levels or barriers, those supports and resistances. Um, Understanding the market structure is going to allow you to tailor your strategy and adapt so that it can suit the current market conditions, because today's market conditions aren't going to be tomorrow's, or the next days or the days after that or 2 weeks from now. It's always changing. So gaining that broad perspective is just going to help you before you zoom in and really look, because zooming in is where that real fine line to get that perfect entry, right? Or that perfect exit, depending on what you're looking for. So this approach is just going to help you perceive your trading decisions better. It's going to it's going to help reduce some risk of entering trades prematurely, or missing opportunities, because something that the market will do is give you every opportunity in the world to make money. It will. And not every opportunity is going to be the right one. So we have to figure out which opportunity is the right one. And to get there, we start with candlesticks. So, candles. Candles themselves. So, the candles have a couple different pieces to them. Now, the body is the actual price range from the opening of that candle to the close during the selected time of your time frame. So, if you're on a minute, that candle's got a minute life, right? 30 seconds to half life, continue on. After that next 30 seconds, you get the next candle, right? So, if it's a green candle, the price started at the bottom to open and it closed at the top. And we're only talking about the body, right? Not even touching the wicks yet. If it's, if the price went down, it's a red candle, it opened on the top of the body and closed at the bottom. So you can follow it. And sometimes when we get in those quote unquote barcode, range days, I call it elevators. So, it is barcoding. It literally is. And you'll know what that looks like when you see it. I don't have any examples at this moment, but so just keeping in mind, if the closing price is lower than the opening price, it's going to be red, indicating a bearish movement. If, the closing price is higher than the opening price, it's a bullish candle. Super easy, right? Well, let's get in a little bit deeper and talk about the wicks, or the shadows. So the wicks just kind of represent the highest and the lowest prices reached during the entire time that the life of that candle was open. So the upper shadow just extends to the top of the body, and it does choose, it is the highest point where that is. So, and same with the lower shadow, the lower wick does the same exact thing. Just tells you how low that price went. So it gives you kind of an idea. Well, can they push too low? Can they push higher than that? Well, let's talk about it a little bit deeper. So we all know bears and bees, right? Or sorry, bears and bulls. So we know that bulls are optimistic. Bears are pessimistic. Sorry, my girlfriend just laughed at me. Bee-ish, yeah, bee-ish, Raymond, you get it. The bears and the bees. Yeah, I said it. Okay, sorry. I'm gonna pull it back together. Um, so bear markets are characterized by falling asset prices, investor fear, economic uncertainty, which we are kind of experiencing now, depending on how you feel about it. Um, bulls and bears actually originate from how the animal attacks its opponent. The bull thrusts its horns upwards and symbolizing the upwards price movement, while the bear swipes down with its paw, symbolizing the downward price movement. Not that you really need to know that, um, but understanding the sentiment of bulls and bears is essentially just going to help you gauge market direction, right? It's going to help you identify the trends. It's going to help you make informed decisions. That's all I want is for you to make informed decisions. That's it. Additionally, market sentiment can influence the overall dynamics of things like volatility and volume, right? Does anybody have any questions? I do want to take a short moment and make sure everybody's. Okay. Let's talk about specific candles because I like candles. So, candles can kind of tell you a lot of different things. And we're going to talk about a couple different candles that are important to kind of bear in mind. The hammer candle specifically is a bullish reversal pattern. It typically forms typically forms after the price decline. It consists of a small body near the top, which is that trading range. It's a very tight trading range, but it usually has this really long lower shadow body wick, or sorry, long shadow wick. It's at least twice the length of the body. Something to kind of keep in mind is that it does kind of have to be a little bit longer. The long lower shadow indicates that sellers push that price down, right? Because we see that from that open, from the if we're looking at the bullish hammer candle, it opened, but they still pushed it all the way down, right? Because we have that huge long lower shadow, but this buyer still came in, pushed it right back up. That's what this pattern suggests. It suggests that buyers have regained control after a period of selling pressure, potentially signaling a reversal of a downtrend. Now, I'm going to say potentially and probability and things like that a lot because that does exist. It potentially. Now, it could just automatically slam straight back down on the next candle. And that's why we have risk management, things like that. So the doji candlesticks they're important to me. They might not be important to every other trader. Now, doji candlesticks to me are a significant technical analysis. They represent indecision, neutrality. They like a standoff between the buyers and the sellers, right? Because they couldn't beat each other to get the asset or the price to move where they wanted it to go, right? So it typically has a very non-existent body. It's usually just a flat line. I will have pictures on the next slide. So there are like a few different types of dojis, but they all have their own characteristics and implications for market sentiment. Um, Most traders often interpret doji candles in the context of surrounding price action, trend direction, and key support resistance levels. Um, Dojis alone are not going to provide a definitive signal, but they can be a valuable indication of the market sentiment um, and possibly reversals. But if you combine this with other things that we talk about later, you'll have a more informed decision. So we've got 3 dojis here, straight from Investopedia. Thank you. We've got the gravestone, the long-legged, and the dragonfly. Now, these shadows aren't always going to be these long. It's just this long for the demonstration purpose. But we're going to talk about each one of these really quick. So the gravestone doji does have a long upper shadow. It has little to no lower shadow, resembling the shape of a gravestone. It typically forms when the opening and closing price are near the low of the session, suggesting bearish pressure. Gravestone doji often occur at the top of uptrends and can signal a potential bearish reversal. We have all seen that, probably, maybe. We've also seen what's called a shooting star, which would have a body. Um, that's what I try to stay away from those personally. I try not to buy that at all. The long-legged doji has long upper body, long upper and lower shadows, excuse me, indicating significant price volatility during that trading session. It suggests indecision in the market and uncertainty among traders about the future direction of the price. It can often occur at key supports or resistance levels, and it can signal potential trend reversals. So to me, the long-legged doji is very, very neutral. Well, maybe not very, very neutral compared to the short-legged doji. The short-legged doji is super neutral, because they were able to fluctuate the price up and down, but it closed at the same price that it opened usually. So, that is nothing. It really depends on your trading style, Duca, and it depends on your strategy. Me personally, I try to stay away from dojis unless I'm already in the trade. Then I'm like, oh, well, I don't know where we're going. And then I have to look at other indicators and try and make a better informed decision on what I should do next. Should I hold this position or should I close it? So I don't want to say stay away from them, but try not to just buy in on a doji, maybe. Because especially if you buy on the top of a gravestone doji or any doji, it's so indecisive that it's really it's tough sometimes to make that decision, just based off of the candlestick alone, right? So to stay away from it or not is a tough question to answer because you're going to have 3 or 4 other things that you're looking at to help make your decision. Because it's not just going to be the candle and the price alone. It's going to be, you might be using, a moving average. You might be using 2 moving averages. You might be using moving average crossover divergence, and we will talk about those a little bit down the ways, and things like that to maybe help get some people onto the right path to understanding where the price is moving. So the Dragonfly Doji does have a long lower shadow, little to no upper shadow. It resembles the shape of a dragonfly, and it really does. It typically forms when the opening and closing prices are near the high of the session, suggesting bullish pressure. Dragonfly dojis can also occur at the bottom of downtrends and can signal a potential bullish reversal. Typically, I get in because I prefer to buy. I try to get in on the wicks of 5 to 15-minute candles on ES personally, and ride that stuff up. Because I do prefer to buy than I do to short the market. So let's do it where we take 2 candles and start referencing 2 candles together. So engulfing pattern, all the time. I see this all the time, just every day, and it's really good to just kind of understand engulfing pattern. It takes 2 candles. So your first candle specifically on the bullish engulfing is going to be red, right? So you have a large bullish candle that completely covers up the previous smaller bearish candle. So they pushed this price all the way down. They bought it back up, and then it closed there at that body at the bottom. And then it fell down just a hair, but then it opened just a touch lower. It might have went down right then and there, or it went straight up. I don't know because I didn't get to watch it happen. But based off of reading this, they tried to push that down and they rode that elevator straight back up. and it's a little bit higher than where the bearish candle opened. Sorry, excuse me, because now we have a higher high, right? We're looking for that too sometimes if you're looking to long the market. So the bullish candle opens lower than the previous candle, closes higher than the previous candle. So it has to open lower and it has to close higher in order for it to be an engulfing pattern specifically. It does indicate kind of a shift in the market, maybe a little bit of sentiment change, but that can change on the next candle. So that's why we have other indicators and things to look at too. So this could potentially lead to a further upward price movement. Now, the opposite of that is going to be the bearish. So we have the large bearish candle completely engulfing the previous smaller candle, and you can see it visually, right? It's a very visual thing too, which I really enjoy because I'm personally partially a tactile and visual learner. So the bearish candle opens higher than the previous candle's close and closes lower than the previous candle's open. Now, I know that's a mouthful. So let's talk about the bearish engulfing on that right-hand side there. So that green candle, it opened. They pushed that price up. It closed up there at the top of the body. It opened up a little taller and they slammed that back down. They said, no, thank you, sir. And essentially, it's a bearish sentiment. With the sellers overwhelming the buyers, potentially leading to a downward price move. So, and the reason I am going to be handing this PowerPoint out is because there is a lot of things like this that I want people to have. You can always look this up because I did snag this off the internet, but make sure I pull this in here. Yoink. Took me long enough, but I got it. Did that while talking. Okay, so basic candlestick formations and reversals. So we know our neutral candlestick patterns. We got our dojis. I didn't touch on the spinning top, which is just a little bit bigger of a body than a doji. You could consider it neutral. I don't know. The price moved, so that might be more of a personal decision if you like spinning tops or dojis and that sort of thing. So we have here bullish candlestick patterns based off of some of the couple things that we had talked about, right? So on this hammer, that price came down. They pushed it all the way down. Buyers came in, and then it continued on an upward movement. That's what we hope to see when that happens, right? We hope to see that every time. Sometimes we're not that lucky, you know. There's also the inverted hammer. You know, the price got pushed down. Buyers did step in very hard on that inverted hammer, but those sellers still pushed it straight back down. But they got exhausted on the next candle. So if you're exhausting the sellers, that means the buyers can push through. Now, we don't exhaust them personally. I'm not exhausting any sellers or buyers personally. So the next one is going to be the Dragonfly Doji. So the price came all the way down, just like that hammer. They pushed it all the way down, but then they brought it back up to the neutral point, right? To that, right where it opened. And then they pushed it on up. The bullish engulfing is going to be the next one we'll talk about, which we do see here. The price comes down, and then we have the actual bullish engulfing candle, and then it goes straight up, right? And surprise, the reverse of all of these are bearish. So if you literally flip these upside down, essentially, and change the color of the candles. So the shooting star I did touch on whenever I talked about the Gravestone Doji, because if it does have a body, it is a shooting star. Nobody wants to buy in on a shooting star on accident, but that's why we have stop losses and things to protect our capital. So let's talk about the shooting star. The price goes up and up, and then on this shooting star candle, they shot it all the way up, but those sellers said, nah, and put it all the way back down. Well, it exhausted all of the buyers, right? The only way for that price to move is to go back down. If all the buyers are exhausted, the hanging man is just our inverted hammer, but it's, we're going up, and then the price got pushed all the way down, but the buyers came back in, right? So they were going for that push down, and then the buyers came back in, and then the buyers were exhausted. And so it goes back down. Gravestone Doji, going up, getting exhausted, going back down. Bearish engulfing, we're going up. We got here, and then we got the candle where they said no, and they denied it. So there's a lot of basic formations and a lot of like reversals and things to look for. These are what I kind of try to look for every once in a while and just keep my mind open to. You could use all of these if you memorize them, So reversal patterns are signals that kind of tell us that there's a potential change in the direction of the market or the current trend. It offers us warnings. There are very early signs of warnings. If we top out and then we come back down a little bit and then we start going back up for that, I might be out of that trade by then. I might wait to see if it gets through the double top. I might not want to risk that. I might just want to take my profit and go. Those are the type of decisions that you'll have to try and figure out and understand while you're trading. So reverse patterns the actual pattern is going to confirm your trend change. It's going to guide you into entering a position in the new trend, right? Because you want to move with the market, you don't want to move against it. They provide clear levels for setting stop loss orders, take profit targets. Something I haven't even touched on is just using bracket orders. We'll probably talk about that when we get to more risk management things. For right now, understanding price action and things like that is the basis to getting further. So by understanding these patterns, you can improve your timing of market entry and exits. So some basics that we all know, we got head and shoulders, which are 3 peaks. The one in the middle is going to be the tallest peak. It's going to be the head. And then you'll have the 2 smaller peaks on the outside where it's the shoulders. And they can indicate trend reversal. And they usually do almost every time. Almost every time. It's wild how that happens. So, and then another one we have for trend reversal is the double top, double bottom. Specifically, this one is going to be the double top here. You've got 2 peaks that are the similar height, and 2 troughs that are similar depths, right? The double bottom would be the flip of that. So that would be the trough. To keep in mind that there is a neckline here on both of these. This flat line on both of these that come across here is called the neckline. And that is kind of like your quote unquote support at that moment until that price actually breaks through and the full movement continues. So this page is going to have this is what I was talking on. There's a bunch of patterns that you can look for, both reversal and continuations I have on here. They are in that PowerPoint that I did. I sent it as a PDF. I apologize, but it is in PDF form there in the chat, so that you guys can snag that and just kind of have that with you. Some things with these continuation patterns to kind of do notice is the symmetrical triangle here at the end. When I see symmetrical triangles, I just stay out because, I mean, I know if it's going to go up or down, and I can look at other indicators, but do I really want to risk that? Me personally, maybe. If I want to maybe scalp the range, sure. Play the top and the bottom of both of those kind of trend lines coming through. Just, try and scalp a little extra money off of that. It can be dangerous. So I try to just stay away from them personally. Anybody got some questions? Yeah, it's like the quietest class I've had so far. Like the quietest class. We can't speak, that's fine. Hey, Braxton, welcome. I didn't see you pop in. Well, luckily the explaining is actually the easy part is that it's all here for you. It's all in that PDF. Like I said, it's just all educational stuff that I compiled. Like I said, fair use because it is educational. Right now, I'm only doing them every other week until I make sure that my other um, educational things that I want to do in here are up to par. Yeah, the risk management. The reason it's taken me a while on risk management is because there is a lot of things, and I don't want it to run as long. Well, I don't want any of them to run like an hour and a half, but because I want to be considerate of everybody else's time. You know, so trend lines, supports, and resistances. I use trend lines all the time. Supports and resistances, I use specific ones, psych levels, implied volatility levels through standard deviations, or looking at a 15-minute chart and just kind of eyeing and hitting and labeling my horizontal line real quick just to make sure it's there. You just draw on the chart. Try and figure out and see where it's going. All of these in these continuation patterns, like look at these, like these flags and these things. You know, these are all resistances and supports that are keeping the price moving in that direction until they break free or they reverse. Um, so trend lines are going to be your diagonal lines that you draw on your price chart. They connect consecutive lows in an uptrend or consecutive highs in a downtrend. Usually, they represent the direction or the strength of a trend, providing us with valuable insights to potential future price movement. Um, to draw a trend line, and I can actually, I don't have it up right now. So you just, maybe I should just pull up TradingView real quick. Because I don't think I have actual. Yeah, I have them on the next thing. So to draw an uptrend line, you connect at least two or more successive low points on the chart. The line should slope upwards if it's going to uptrend, right? To do it the other way, you go from the top. So to draw the downtrend line, you connect at least two or more of successive high points on the chart, and the line should slope downwards. Now, everybody's technical analysis is going to be different. Not everybody's going to have the same representation or even sentiment as another trader. Like Riz and I were talking before this all started. I'm feeling bearish. I'm not even a bear. I'm feeling bearish. And Riz is kind of indecisive and wants to wait and see. And those are the sorts of things that you'll encounter, and that's why we have open forum and discussion, and that's why we find the data and we represent the data and we try and back our hypothesis up. You know, so ideally, your trend line should touch as many price points as possible without cutting through any candles. I'm not exactly going to agree with Wix. I like mine super tight, right on the bodies personally. Just how I like it. Um, that's just how I do my charts. Not everybody does it that tight. Some people like to keep in the wicks, in mind. I just want the exact price of what we were trading. Even though the wicks do represent price action that has happened, the wicks got pushed for me. So for me, I'm still trying to continue and see where else we're going to be moving. So support and resistance levels are going to be a key concept. They're going to help you look for congestion, reversal places. Like if the price is coming down and you're thinking about, I want to get in at this support here. Well, you wait for it to come down, it touches the support, it bounces up, and then it comes back down, and then it touches that support, and then it goes straight back up. That's a double bottom. How do I incorporate volume analysis into my trading decisions? Personally, so for my futures, I do a VWAP for session that starts at 5. And then I have one for London that I place for a anchored VWAP. And then I also place one 30 minutes after open. Well, not I place it on the open, but I wait till 30 minutes after the open because I don't touch that personally. So I use those as representation of where the price is based on the volume, right? So because that's different than where the price is when after all of the crazy things happen right in the open, and then we get that really low volume in futures. It's much lower than it is in those first 30 minutes sometimes, like right before London close and that sort of thing. So I try to, like, if I see that we're open, I wait for open 15, and then we kind of move around and we go straight down or something, or we kind of hanker down a little. And I'm just trying to look at, where is the price based on all of the volume? And if it's way up there, then I might be looking for a long if all my other, 2, 3 other indicators are saying, hey, you should probably think about a long. Then I'm probably thinking about a long too. And those you kind of get to those decisions as you learn what indicators you'd like to use. But I will always suggest using some type of volume indicator, just because whenever you don't have volume, things look a little weird. Um, like in futures, right after we get to 10 o'clock, and the volume's the average volume is lower. 10 o'clock, 10:30, and then I'm looking. Is it going to move? Is it going to go up? But if there isn't as much volume, then there's not as much participants. Then where's the dissonance between the buyers and the sellers at that point? And how do I come up with that? And when we get to more indicator, when I blow over a bunch of indicators here in a little while and we talk about those, we'll figure out which ones are good ones that we want and which ones we don't want. Because I'm not going to use an RSI with my stochastic RSI. And we'll discuss, kind of why we do and don't do those things. So support levels, price levels where buying interest is expected to be strong enough to prevent further price decline. All support level is, resistance is the exact opposite. It's where the selling interest is expected to be strong enough to prevent the prices from advancing. They typically, all of these levels coincide with previous highs or lows, where that pressure originally was, historically. Is it always going to be that way? But that's why we have to stay aware of what's happening in the market. So support levels may become resistance levels, what's broken, and vice versa. They represent psychological and historical levels where traders react to price movements. And we look at that by just looking at previous data. So let's talk about this guy. So it's a very long chart. I just realized this was over 20 years. Okay, well, I feel dumb for not knowing about IBM like that, but okay. So let's talk about this chart just a little bit. You can see there's this trend line. That's a really, really long trend line. A very long trend line, right? But throughout all of this, throughout all of that trend line, we have deviations from that trend, right? So when that price went all the way up to that top of that first, it says support line, but at first it's the resistance, right? You know, that's that resistance, and then it came back down, and then it tried to go back up, and it couldn't, you know, and it tried to peak back up again on that, you know, that last peak before coming down, couldn't quite make it back up to that support line, right? So that's going to be something that tells me if it can't get back up to that resistance. Sorry, it's a resistance still. If it can't get back up to that resistance line up there, that's an indication for me to get out. I don't want to be anywhere near. It's not making it, or maybe I'm looking for a short at that point. You know, depending on how you look at it, you know, how you infer the data is how you're going to adapt your trade strategy, right? So this specific trade suggests that they entered at 101 down here because they see that it caught back on this trend line, and it did show that it's coming back to this 101 where there was resistance before, and it broke through. So that's going to be an entry point, and then you're going to want to exit right before you get to what's currently, it's not the support line yet because we haven't gotten above it, right? And we're going to want to exit right before that and escape with a bag, you know? Well, in this case, this person executed that trade. It went up to near that resistance, and then it came straight down to that trend line. But then it recovered, right? It recovered, and then it consolidated at the top, and then it pushed through. Now our resistance is a support line, and they took an entry after it was confirmed above, and they wrote it to the next exit at the next resistance. Now, how they got to that next resistance line, they could have used a couple different ways to make that decision on how to get to that resistance line. They could have used, you know, Fibonacci. They could have used fractals. They could have used all kinds of different things. Implied volatility levels with standard deviations. There's a lot of ways to figure those out. So this is an ugly chart. Oh boy, we're going to fix that later. Okay, so this specifically is a flag. So you'll notice how the price continuation continues in the direction of the original trend once it breaks out of the flag, right? So this price came all the way up, and then it came up, and then it hit the top, and now it's in this channel, right? And so now we're channeling down, and we're waiting on the price to really push up past that down sloping line to break over through that flag. That is an ugly chart. I'm gonna get a better flag chart because that's not great. So, does anybody have any questions yet before I get on indicators? Okay. Cool. I personally need some water, but so indicators. I use 1, 2, 3, 4. 4 because I consider like implied volatility levels an indicator. based off of, that sort of thing. So indicators refer to mathematical calculations or visual representations of price or volume data that is used to analyze market trends, identify trading opportunities, and make informed trading decisions. Indicators are based on historical price data and are applied to charts to help traders understand market dynamic and predict future price movements. The number of positive indicators required for a trader to decide to take a trade can vary depending on the individual trader's strategy, risk tolerance, and market conditions. I took my time on that one because that's super important. Based on your strategy, you and I are probably not using the same indicators. Like I know Riz and I probably are not. We might use one or two that might be the same. We might use one MA or something. I know Moist and I use a moving average that is the same. We actually use two moving averages that are the same. So that's just something that we have in common. So depending on your strategy, the market conditions, that sort of thing, you may prefer to wait for multiple positive indicators to align, which I'm going to highly suggest wait for them to align. Just wait. This trading has been always more about waiting because every opportunity is an opportunity, but you don't have to take every opportunity, and that goes with anything in life. You don't have to take every opportunity, right? Because not every opportunity is going to be the best opportunity for you. And that's why we're going to use indicators, looking at a few of them to understand and make sure they align before we enter our trade. Now, I may be comfortable taking a signal off of one of my, like a MACD versus something else, because it might be, it feels to like a stronger indicator to me. A MACD feels like a very strong indicator to me because I like breakouts and I like crossing overs, and I just like that. I like things that oscillate. I like, that I just like it. I like things that I can see where they go to a peak point and they come down, and then they get to all the way to the bottom. I like being able to see that visually, personally. But that might not be the same for everyone else. Somebody else might prefer a regular RSI versus a SRSI, and ultimately that's just going to be to take that trade is up to the trader through the analysis of the market environment, the strength of the trade setup, your own trading plan, risk management rules. You got to have rules. It's super important for you to develop a very, very clear set of criteria before entering trades, and then do that every time, because that's what's gonna make you successful, is being disciplined to your craft, being consistent in your approach. That is what's going to make you a solid trader. So, indicator factors, things that make up the indicators. So, the trading strategy. So, like a MACD is going to work a little different than a regular RSI, but it does work a little similar to a SRSI, maybe. Because there is a crossover that is kind of involved with a signal on an SRSI. But different strategies have different requirements for entering trades. Some strategies rely on a combination, while you may focus on a specific signal or maybe even like a candlestick pattern that's forming. Risk management's important. You should consider your risk tolerance, potential consequences of entering the trade, based on how many positive indicators that you do have and what you don't have. So you're just gonna you will implement proper risk management trading and techniques, and you will learn those in setting up stop loss orders, mitigating potential losses through stop loss, or setting up bracket orders in order to resting orders just to ensure. And once those trigger, then then the resting order sits for your stop loss and your take profit, that sort of thing. And you can set all of that up. There's multiple ways to go about it, and anybody in this service, probably, if you ask the question, they're probably going to help you out, because that's all we want is everybody to make good decisions. So risk management, super important. So you are going to wait for confirmation on your signal, on your indicator. You're not just going to be like, well, my RSR, my stochastic RSI is all the way at the top. I'm gonna go long. Probably not the best idea, because it's the opposite of what the indicator is saying. So if the indicator is saying, something else, um, you know, follow the indicator. Your indicators are there to help make you confident and more confident in your trade, right? And watching those trade setups and watching your indicators while those trades set up is just going to increase your likelihood of success. But do realize that you can have too many indicators. You can overanalyze and you can miss the best opportunity. So finding the right indicators does take a little bit of trial and error. Paper accounts are free. You can just get on TradingView. They have so many indicators. You can go through so many really cool, just different things, that TradingView has, and they allow you to use their paper. You can get a paper account on TradingView. Duke, that's a good question. I would at least three, two, two or three. What would you say, Riz?
I'm sorry, what was the question?
How many indicators would you recommend most people use?
I'd probably say at least 3 to 4. You want at least
Yeah,
3 or 4 confluences. That's why.
yeah,
One or two is just not good enough. The third one is your third confluence.
yeah, yeah. I agree with that. Yeah, at least three, four, at least.
I wouldn't do more than 5 though. I would not do
Yeah,
more than
yeah.
5.
Five
You'll
is gonna.
you'll have a bunch of conflicting things going on. Your chart's gonna get crazy. But yeah, just 3 to 4 is probably the sweet spot of where you should be at. Ideally, if you're just starting off, you just want to have 3. At the very beginning, you're just going to want to have 3 because you just need to have 3 boxes checked off. Then once you start trading a little bit more and you want a little bit more precision and you develop some patience, because at the beginning you're going to be very impatient, and that's all that trading really is. It's a patience game. You might sit there for 9 hours trading and you might not make any money, or you might make $20, or you might make $10,000. You just have to understand is that every single day will be different, and you may not necessarily hit your target or even close to it like you did the day before. So you got to take the windfalls with the losses.
That was beautiful. That's yeah. Which is a great segue into market conditions, because market conditions aren't always going to be the same. Like you said, today you could make 10 grand. Tomorrow you could make $20. You could lose 100. Yeah. The day before you had a trend day, and today it's uh, like 10-point range. Like it's awful. Um,
Yeah, I think someone was asking also about indicators because there's so many. Yes, there are thousands of indicators. There's different types of candles. There's oscillators. There's strategies. If you're a new trader and you're trying to figure things out and trying to learn at the very beginning, then you want to keep it simple. The simplest strategies are going to provide you the easiest methods to learn, and then you'll be able to build on success from those. And the reason I say the easier ones is because if it's too complicated of a strategy and you're still trying to understand the verbiage and what everything means, then you're going to get stuck in the weeds of these complicated strategies. They're going to throw all these words that you've never heard before and you don't understand, and you're going to get sidetracked and you won't focus on the strategy. So I really suggest that focus on something simple. EMAs are very simple. Fibonacci lines are very simple. Support and resistance lines, trend lines, trend
Mm-hmm.
lines, support and
Mm-hmm.
resistance, and EMAs. Those would be the three easiest strategies I would start off learning. Or,
Absolutely. Absolutely. I 100% agree with that because EMAs are super easy to access. You just click the button, you turn it on which one it's supposed to be on, and we will talk about indicators specifically here in just a second, like because I have a whole list to go over. I wasn't just going to leave everybody high and dry. So, experience and expertise. Experienced traders are going to rely on more knowledge and intuition that they have from trading and using multiple indicators, right? Um, Novice traders, on the other hand, may prefer to wait for more confirmation, and that's okay. That's fine. I'd rather you wait than toss it all away. You know, that's the last thing I want anybody to do is just be tossing money at the market and just trade paper for as long as you can. I still trade paper, still, still because I love it. But that's neither here nor there. So moving averages, we got a couple different kinds to talk about, and they represent weight differently of the price, right? So we have moving averages, very widely used by I still I use EMAs and SMAs still. Um, on my chart, I just leave them there because I like them. Um, I like them. That's why I use them. They work for me and they coincide and work with other indicators that I use. You know, um, so these moving averages are going to help also identify trends and like reversals, resistances, volatility things. Um, but they filter out short term price fluctuations, which helps get rid of some of the noise, which is, for me, it comes down to getting rid of noise, getting rid of things that are going to, you know, tip what I'm trying to accomplish the wrong way, because the market's so volatile that it's going to move and it's going to make me think that, oh, this trade's not going to go all the way through while all of my indicators are green, you know. So filtering out some of that stuff with moving averages that are plotted on that price chart for you, it's just going to help you just kind of calculate the average price movement of the securities, you know. So let's talk about the simple moving average first, because the SMA, super easy. I keep both a SMA and an EMA. They're two different periods on my chart at all time. Um, I think my SMA is like a 12 or a 15. And then my EMA is a 9. Um, because my 9 is more recent, is a smaller period. That's more recent price data. Um, so the simple moving average is going to tell you over the periods of the time. So let's take the 50-day that we all look. Well, maybe not we all look. I look at a 50-day SMA every once in a while, depending on what I'm trying to do. But it's going to tell you the average closing price of the security over the past 50 days, with each day having equal importance, right? Now, that doesn't take into account um, things like the EMA does, which is the EMA, because it is exponential compared to simple. Um, it's more responsive compared to the SMA. So it's gonna move with that price a little bit more. So if it does go down, it's gonna kind of curl down with it. You'll see it as that price moves on that chart. Um, and it calculates the average price of the security over a specific number of periods. But there's more weight given to the more recent prices, and that's why it's exponential. So EMAs do react more quickly to price movement, making them popular for short-term trading strategies, and that's why I keep a 9 on my chart. because it's short term. It's going to help me decide if I need to quickly do the thing or not, you know. And I do look at other things, um, and we will talk about those other things in a couple slides. So moving averages smooth out the price data. They're going to show you short term, you know, it's going to average out short term fluctuations and provide you a better picture, more clear picture of what the underlying trend is. Um, in an uptrend, prices are going to typically remain above the moving average line, indicating bullish momentum. And the opposite of that, as we know, in a downtrend, prices usually stay below the moving average line, signaling bearish momentum. Um, Crossovers between different moving averages or between moving averages and price can indicate potential trend reversals or shifts in momentum. Now, this is why I have two of them on my chart, while also keeping a MACD in mind, which is a moving average crossover divergence, and we will talk about it. So traders often use these in conjunction with other technical indicators to confirm your signal, filter out false signals, because that's what I've been focused on these past few months, is really filtering out false signals. And I've done that in multiple different ways, doing studies on Thinkorswim, doing studies in PineScript, and doing all of that. All right, Duca. Well, you, my good friend, have a good rest of your night. Oh, I'll send him a message later then. Okay. Well, anyway, so let's look at an EMA and an SMA together, right? This is what it looks like. So the EMA's in blue and the SMA's in red, right? So you can actually see the crossover happen on this as this price comes up. It comes back down, and then it came back down. And then there's that crossover where the SMA comes over top the EMA, and that's signaling bearish movement, right? And as it comes all the way back down, we got down to the bottom here at 61-ish, and then it came back up and it touched that EMA and it got denied, right? And then it came back down and the buyers came back in, and then it went back up to where that EMA SMA is. And then you see the EMA crosses over as that price shoots way up over that, came back down, went a little bit below kind of that SMA, but it caught and went back up, and that price still continued to move forward upwards. And this is just a visual representation of how the price is moving and how you can use two things to kind of look at it and be like, oh, well, this might be, well, if this just came up over here, well, it's going to go down, and that's kind of the intuition that you'll learn over time and you'll gain. So moving averages are just the beginning to your tool belt. As Rizzler talked about, we've got oscillators. We've got relative strength index, the stochastic oscillator. We've got moving average crossover divergences. We've got commodity channel index. We've got rate of change and the Williams percent R, which I've never used that, or the rate of change. We have volume indicators, right? On balance volume. We've got accumulation, distribution line, AD line, and then we've got volume weighted average price, which is one that I use a lot, which is VWAP. I use a session and I use an anchor, a couple anchors. Then we have things like volatility indicators, which ATR, average true range, is a good one. If you're really looking for some good risk management, ATR has some good ways to manage risk that I really enjoy. Bollinger Bands are another volatility indicator. Standard deviation is one that I use standard deviations on a couple different things that I do in order to kind of figure out, well, how high and how low can this go, if it were to be crazy. So then we have trend indicators. We have our average directional index. We have the ADX, the parabolic SAR, stop and reverse, Ichimoku cloud. We have moving average ribbons. Those for me specifically, I typically don't use trend indicators because while I'm plotting lines on my chart, I can I can define and understand those trend indicators. Now, somebody early in their trading journey might not be able to do that. So one of these might be something that you might add just to make sure that you're on the right side of that trend. You know, and again, supports and resistance indicators. You know, you've got pivot points, Fibonacci retracement levels, trend lines, your horizontal support and resistance. Those are all things that you can just click and draw on the spot. You can do those on the spot all the time, you know, and watching it as the price moves, right? Um, we can look at our chart patterns, which we have talked about. That's a major technical analysis thing for me is, you know, candlesticks, chart patterns, drawing lines. Those are the biggest things for me, you know, um, just to understand where that price is, where it's going, you know, while I'm looking at, you know, my stochastic RSI and seeing if it's overbought or oversold. You know, if it's overbought, then I'm probably not going long. You know, I'm probably going to wait. So we do have volume oscillators. Um, Chaikin oscillator. We've got the money flow index. There's the volume weighted moving average, which is a good one to look at too. Divergences are great to look at. Um, I don't know why it says MACD divergence. Moving average crossover divergence. Okay, we'll go with it. Um, so moving average crossover divergence, I did talk about that. Essentially, a MACD is going to be this, but it's going to be on a separate panel in its own indicator, you know, in order to show you, you know, where it's at, where how much volume's coming in, where that volume, if that volume is more heavy on the sell side or if it's on the the bullish side, if it's being bought up or not. And all of that's built into one indicator. That's why I've used MACD every once in a while. I like it. It's a great tool for me. Um, the stochastic divergence is one to look at. And then we look at things like price action patterns, engulfing patterns, the bearish and bullish that we talked about, dojis, we look for those, the hammers, shooting stars, that sort of thing. Um, Inside bars, we look for, you know, triangles, we look for everything. You know, we're looking for those specific, you know, chart patterns, price patterns. We're comparing those and what they say with our other indicators to make sure everything's in line. And then we make the decision: is this a good trade that I should enter, or is it not? And if 3 and 4 indicators say yes, probably a good one. You know, and you'll understand your indicators as you watch them, and you know, check them out, see how they react to previous data and how they moved. You can take trading view and put it in replay mode and watch it all move in not real time, but you can watch it move, which is going to give you, you know, helpful insight on how it moves live, right? Which is are things that you're going to want to try and understand, or how do these indicators, how do they move live? Um, there's cycle indicators that you can look at: the trend price oscillator, shaft trend cycle. There's market breadth indicators, advanced decline line, McLaurin oscillator, arms index. Like there's just a lot of indicators out there. You know, there's wild theories with like Elliott wave theory and like all kinds of just crazy things that can help filter noise out. But you don't want too many of them. You just want enough to help you say yes or no, right? So these are just some common technical analysis indicators. Each indicator has strengths and weaknesses, which is why it's suggested to use 3 or 4. You know, use them with your chart where you're marking your chart. Um, Traders use combinations of them to improve the accuracy of their trading decision. It's important to understand how, you know, each one that you're using works and how they work in conjunction with each other, because them moving together and doing the same kind of confluence and movement together is what's going to make you have that real confidence in the comprehensive trading strategy that you have, right? Um, and that's super important. So This is going to be the final Q&A, I think. Oh, you do have homework. Uh, Not real homework, but does anybody have any questions? No. There's no stupid questions, I promise. I'm not even going to say they're stupid people because this is ground level stuff right here. This is like ground level stuff. This is like the most crashiest crash course that I've ever created. Raymond. You know, Michelle, that's actually in the first one that I hosted. That's that's exactly what everybody thought. And I was like, why is nobody I was like, why is nobody asking questions? They were like, well, we don't want to ask stupid questions. And I was like, no, no, there are no stupid questions. You can ask any question. I do not care. I'm not going to belittle you for asking something that might sound stupid in your head because it's not really a stupid question. Because to be honest with you, trading is one of the most confusing things when you start.
I don't know. I think the only stupid question is the one you don't ask.
Yep, there you go.
What's up, Michelle? How's it going?
So quickly, your homework is to learn about economic events, how they affect what and when you trade. It's okay to trade during news as long as you are trading your strategy. It's not okay to trade the news hoping it's going to go your way. Okay? I want to be very clear on that. I personally stay out of news. I don't like it. But news is all the time. It happens every day. We're on a 24-hour news cycle, so it doesn't matter.
Yeah, but market news is a little bit different.
Yeah.
PMI stuff like that.
Yeah.
You know, you want to probably collab with other traders and find out what are some of the methods they use. Cat doesn't like to treat the news. I like to have a position going into the news cycle. So
Mhm.
I'll get up early and I'll be in a position 4 or 5 hours before, so that hopefully my position is sufficient to where I don't have to worry about too much drawdown or anything. Depending on the way I'm leaning.
So another thing I want you to do is understand the psychology of the current market because the psychology of the market changes. Understand the psychology of market movers and makers. There's a lot of really cool reading you can do out there, understanding how they actually move and make the market, how they make pullbacks happen, and all that crazy stuff. There's all kinds of reading material on it. Um, Understand the psychology of yourself is what's going to be most important. um, Understand what makes you tick, what makes you go against your indicator, and crush that and get rid of it. um, Understanding yourself, you're going to understand yourself a lot through trading. If you go the full 9 yards with it, you're going to completely understand who you are as a person. You just you know yourself so much. I don't think I would know myself as well if I never started trading, honestly. um, like what makes me tick and what makes me do the wrong thing, and smashing that all out, and just all of it, you know understanding, like, I have a aversion to risk. Which, how do you have an aversion to risk when that's how you have to have risk when you trade, right? So, like, how do you have an aversion to risk? That doesn't make sense. Well, because I don't want to lose my capital. And that's a psychological thing that I've worked on, and I've talked with a lot of people who have helped me get over that, actually, over time. Take the time to find strategies for your or strategies for your indicators, indicators for your strategy, um, and test them all on paper, a lot. Test them until you hate paper, and then keep testing it on paper until you like paper again, and then test it again until you hate paper. um, Seriously, just just test it. Test it on paper. 100% test it on paper. Just and try to look to make less trades for better rewards if you can. Sometimes the market's not always going to give you that opportunity because we might end up in a range. We might be straight stuck in the trend, and how do I get into the trend? That sort of thing. You wait till it comes down to the trend line that you want to get in on, and then continue as long as your indicators say that. Um, you know, I personally now look for less trades for better rewards. And then if you need help, please ask somebody, you know, at me in the chat if you got a question. I live here. You know, Rez said it last night during conversation. I live on Discord. I'm always here. It's like, so am I. Like, all you have to do is at me. I get push notifications to my phone, even on Do Not Disturb. That's the only thing that I get that's through Do Not Disturb. Is I don't get phone calls. I don't get text messages. I get messages from people on Discord.
Yeah, and there's a handful of members that are in the audience. So if you don't have a friend, add a friend. If you have someone that you chat with, you know, add them as a friend. Part of trading is not necessarily going at it as a lone soldier. A lot of the beginning parts is having a group of other people that you can collaborate and throw your ideas with and vibe with and be like, hey, I'm looking at this. What do you think about that? Or ask them questions about things you don't know. You know, I learned most of what I've learned. I've learned all of what I've learned from being just where you were at. You know, sitting, listening to someone, writing down notes. Oh, I don't know what this is. Let me Google it real quick, and doing those things so that I could educate myself to where I could get to a point and have a conversation with someone and say, okay, how do I do this? And what does this do? And if I do this, X, Y, and Z, because then I already knew the terminology. So, you guys are going to want to do that homework.
Yep. And that's why this is the quote unquote homework, because you know all of this here is just going to help you. It's just going to help you get that ground level moving higher. Stepping up that ladder. I put a quote down here just for shits and giggles. But if you know what everyone else is doing, you can plan for every step of success. It's it's that easy. If you can figure out what everyone else is doing, you can win. That's the last slide. I don't have. That's all. Unless you guys have more questions for me. I will drop this back in here just in case. I'll probably drop it in my channel specifically too, so that it doesn't just disappear. So that it is there. It is in a PDF so that you can download it to your phone if you want to look at it on your phone and that sort of thing. So it is easily accessible. But that's all I have on the crashiest crash course of technical analysis. Paratroopy. Dragonfly Doji does look like it. So Raymond and I worked closely to get him set up on the right path to success, which is why he's making these jokes. I am not a financial advisor. I do not work in the financial sector. I would not be able to give this class if I was. Essentially, even at that point, if I said it's not trading advice, as a financial advisor, that would still be considered financial advice because I'm legally allowed to give it. But nope, I don't work in the industry anymore. So Yeah, I worked on the bank side, Raymond. Well, the market's closed right now, so if nobody has any questions, no, start looking into some indicators. You are very welcome, everyone. I have no problem doing these. I love teaching. I've taught educational things for a while now, mostly audio, but that's one of my other passions. Um, but I've done a lot of teaching, so this is natural and I love it. Yeah, hopefully I could get some risk management really knocked out because it's a lot like this where it's like there's a lot of information that I want to cover, but I want to have the most important things, but all of it's important to me. So it's hard to kind of, you know, filter out the noise. But we will definitely have more educational formats, and I will definitely have more content, different content, better, not better content, but different content, um, just to try and help get everybody in the right step forward. Because that's all I want. I just don't want people, keep throwing money at the market. That's the only thing I don't want. I want you all to make good, informed decisions about your trades. That's all the cat wants. All right, friends. I am going to. I'll, I'll hang out for a little bit.